Welcome, everyone. Great to have so many of you here for today's discussion. Before we begin, just a quick reminder about the Fusang community. If you haven't joined already, download the app today and cut through all the noise around digital securities. You can join groups, start conversations with other investors, and participate in regular webinars like this one. Okay, so on to today's topic. Are Binance stock tokens for real? I'm Hin Liu, and I'm a legal and business consultant here at Fusang and a lecturer of law at the University of Oxford. Here with me is Henry Chong, CEO of Fusang, and we're a company dedicated to helping you list and trade digital securities with ease. And I'm also here with Benjamin Quinlan, CEO and Managing Partner of Quinlan Associates and the Chairman of the FinTech Association of Hong Kong. Before we begin, let's set the scene. Now, there are many types of blockchain tokens in this world where digital assets are becoming more and more popular by the day, as we see through the recent crypto surge. And certain blockchain tokens purport to be linked to another asset. So this includes things like crypto shares, crypto bonds, equity-linked crypto tokens, crypto derivatives, utility tokens, etc., etc. And I'm not talking about the typical cryptocurrencies like Bitcoin or Ethereum, because they don't purport to be linked to some other asset. So with all these different types of tokens that are somehow linked to another asset, how do we categorize them? So in short, I think we can classify them into three distinct types. There's the ICO, which is the initial coin offering. There's the STO, which is the security token offering. And finally, we've got the digital native securities. Let's go through them one by one. First off, we have the initial coin offering, the ICO. So this is a blockchain token that offers you access to a utility or a service of the company that issued the token. And for example, the token could allow you to use a particular service of the issuer company, such as a particular part of their platform. And in a typical ICO, there are no rights that are linked in any serious way to the value of the underlying issuer company. So it's focused much more on the use of a service or utility within the company. Second, we've got the STO, which is the security token offering. And this is interesting because we've got contractual rights in an STO against a counterparty that are linked to an underlying company. But the counterparty and the underlying company may well be different. So, as we all know, with the Binance Tesla token, the counterparty, the party that you've got rights against, is Binance, not Tesla. Whereas the underlying company which the product is linked to is Tesla. And this is an overview. STOs encompass various subcategories, but the most important categories are derivatives and investment contracts. Now, derivatives are where the value of the contractual right is somehow linked to the underlying asset, such as a share. Again, if we take Binance's Tesla stock token, which we'll come on to, the value of the token is somehow linked to the performance of Tesla's share, although we query how strong the link is. And common types of derivatives include options and futures, which we see on exchanges, as well as swaps. Now, with investment contracts, the typical case is where the value of the contractual right is expected to increase if a particular financial metric of the company improves as defined under the contract. So for example, we've got a revenue token where token holders would be entitled to a certain percentage of the company's revenue, or that the value of the right would be connected with the company's revenue in some form. Now, this is the most exciting one, which is digital securities, the last type. These are the purest form of a blockchain bond or share, where the blockchain entry itself denotes the share or the debt. And this is the strongest possible link that we can have between the investor's rights and the performance of the company, because there's a one-to-one link between what's shown on the blockchain entry. And this is shown on particular websites, for example. And there's a one-to-one link between such an entry and what the investor actually owns. And this direct link contrasts with the STO, where the link is much more tangential. So let's take Fusang FSC shares as an example. There's a public Ethereum blockchain where the entries on the public blockchain are conclusive indicators of the shareholders themselves. And with digital securities, the investor has full rights in the share or the bond. So with a share, you've got the rights to declare dividends, in entitlement to the capital appreciation and the value of the share, which is a fraction of the share capital. We've got voting rights, liquidation rights, as well as other rights contained in the company's articles of association. With the bond, we've got the right to principal and interest payments, and there might also be other rights stated in the bond. For example, voting rights. So guys, how do you think we should classify Binance's stock token? Is it for real or is it unreal?
Well, maybe I can grab that one first. And thank you everybody for coming and joining today. You know, I think the Binance stock tokens, as they've been very publicly marketed at, are a really interesting example of just how much interest there is in digital securities. No secret, crypto is garnering a huge amount of attention right now. Elon Musk was on Saturday Night Live, a night or two ago. And, you know, when I go to the gym, literally everyone I can hear around me is talking about what crypto to buy. Or recently it's been NFTs. That I think people more and more are starting to ask, you know, these tokens are all very interesting, but what do they really represent? And whenever there are the glimmerings of people coming up with tokens that are actually backed by something, people seem to get awfully excited. The problem is, and I guess the issue I have with Binance is, I think there are really only two kind of options in terms of what that stock token can be. And quite frankly, it's not very clear from their marketing, or if you go into their website, what exactly it is. And actually, I have been to the website and it's changed over time, their description on the website. So when they first launched these tokens, they said, look, these will allow you to get a fractional interest in shares. But if you read the bottom of the page, it said, asterisk, asterisk, please note, these tokens confer no legal or contractual rights whatsoever. So it's just the ICO token, basically. Maybe we will actually try and see if it's backed, but it's not a derivative. It's not linked in any way. And Binance was very clear that this is why they were exempt from securities laws, because it's not anything. It's not a security. It's just an ICO, no rights whatsoever. I think they've changed that since, because they recognize that that story doesn't really fly with investors. And they now say, oh, it is backed by tokens, but it's basically some kind of derivative or investment contract. Or sometimes they also say, well, actually, no, it is a share, but you're not, Binance actually isn't involved at all. These stock tokens, you're dealing directly with a broker. A little confusing. To me, the point is, when you're offering these kind of tokens, real digital securities, real shares to people, to investors, there shouldn't be any ambiguity in the first place about what it is. You need to be very clear of what you're selling, and investors need to be very clear as to what they are buying, what exactly they're getting. If it's real straight equity, say so. If it's a derivative or some kind of complex investment contract, they should say so as well. But anyway, I don't know what you think, Ben.
I'm with you on that. I think for the benefit of the people on the call who don't actually know how the mechanics of this works, the basic idea is Binance have set up a fund management company, and that fund management company will purchase traditional securities such as Tesla, as Hin mentioned. They will then create a tokenized representation or fractional ownership in that fund management entity, which then mimics or masks the ownership in the shares. Except to Henry's point, the reality is there is that contractual nexus is now broken. You effectively have a fractionalized proportional ownership in something, some underlying, but the legal guarantee or the obligations or the rights that come with actually being a shareholder are now gone. And from what I understand with their marketing, they seem to be saying that, well, there's no fees on trading into and out of these particular tokens. But no fee also, if it comes with no rights, makes me a little bit concerned. And the whole phrasing it as a stock token is a little bit what I would call ambitious in my view. It feels like, given my background, more of a Delta One style product to me. But again, operating in a very unregulated space when this is far more regulated in my view.
Absolutely. And maybe just unpack that a bit, for everyone listening. Delta One is usually the term that people apply to any kind of derivative that just tries to track the underlying price of something. And I think that's a totally legitimate way to do things, as long as you're clear on the tin that that's what you're doing. So for example, Archigos recently, this big family office that blew up, that's exactly what they were doing. They were buying all kinds of swaps with banks. And that's a very normal financial instrument that hedge funds will use to get exposure to, especially if they don't want direct exposure for some reason. But when you're doing that, you need to be very conscious that you are trading against a counterparty. So if I'm writing a swap, if I'm Goldman Sachs and I'm writing a swap on Tesla, this has nothing to do with Tesla. This is between me on one hand and let's say Goldman Sachs. If something blows up or something goes wrong and I go to Tesla, Tesla are going to say, this has nothing to do with me whatsoever. Go talk to the guy that you wrote the swap with. So the next natural question is counterparty risk, right? I'm basically betting, I'm taking risks from whoever that counterparty is. And to me, more importantly, these kind of contracts, I think it is legally very, very complex to think about what fractionalizing them means. What does it mean if I own 1% of a swap, right? What happens if this thing goes wrong? Who gets to enforce these things in court? Because again, these are contracts, and like all contracts, you need to go to court to get them enforced. They're not like traditional shares, bonds, etc., where there are all kinds of natural investor protections, where it's well understood how that process works. And every contract is unique, right? You got to read the terms of the contract to figure out what exactly you are getting. And for all of those reasons, even if you are going to sell quite legitimately derivatives, usually most regulators aren't very happy for you to sell them to the public, to retail investors, precisely because it is complex. So for all of those reasons, I think Binance is stuck a little bit between a rock and a hard place. That's why sometimes I think they flip-flop between saying it's not anything, and then they say, wait, we can't say that because that doesn't look good on the marketing front. So we'll say it's a derivative. And they say, oh, well, we can't say that either because there are still rules around derivatives. These are still, whether it's security or a future, every single country in the world has rules around how these things are, created, placed, traded, etc. So I think it's a little murky. And like I said, the long and short of it is, doesn't matter which kind of option they're going with. I think that you need to be exceedingly clear when you're dealing with investors in terms of what exactly they are getting. So.
And maybe the best way out of this is for Binance to keep the agreement unclear so that they evade all these regulatory regimes, right? So we don't know what the investors' rights are from the face of the agreement. And of course, we do broadly know that this might fall within the category of an ICO or maybe an STO, but we don't know much more than that. So is it an investment contract or a perpetual futures contract? And this is extremely concerning from an investor's perspective because they won't really know what rights they have. And this links in with the fact that these stock tokens are unregulated. And it's really concerning.
Yeah.
So although there's some ambiguity about it, go on, Ben.
Go ahead, go finish.
I was just going to say that although there's some ambiguity about the investor's rights, it's crystal clear, as Henry says, that Binance markets these stock tokens as a tradable instrument that replicates the market value of the underlying companies like Tesla. And this in itself, in my view, should trigger regulation under any credible securities regime. Because if we strip the meaning of a security down to its essence, it's a tradable financial instrument, which is precisely what the Binance stock token is, plain and simple. And so there should be a very strong form of investor protection. And you might wonder whether the terms of the contract provide this level of protection. And as you probably have guessed, absolutely not. In fact, it's the opposite, complete opposite. For example, Clause 8 of the services agreement is worded in extremely lopsided terms. It says that Binance has a right to terminate the stock tokens trading service at any time. But then what happens when, for example, the trading service is terminated? There's no consequence that's specified by the agreement. So there's like absolutely no guarantee that investors would receive any returns at all.
Yeah, I mean, if you look just broadly at crypto land, the reality is everyone's been playing regulatory arbitrage for a very long time. And that reg arbitrage window is getting smaller by the day. And firms will always try and get creative around which jurisdictions they operate in, the products and services that they provide, and just playing as much as possible in that gray area. Now, for those of us who've been around a while, it's not even that long ago that we saw the last crypto boom, 2017. We're in the midst of another boom. We're in an everything bubble at the moment. There's literally no asset that you can buy that's not going to do well right now. I think the long and short of it is people forget about what actually matters when everything is on the rise. But we've all seen what happens when things fall over. And at that particular point in time, and everyone is debating, it's not if, it's when. But at that point in time, you better be sure that the contractual entitlements and the obligations and the rights that you have in your investments are as sound as possible. Because if you haven't done your homework on that, then we all know what happens with a lot of people that got in 2017 when things just went up in smoke. BNB, like Binance, BNB actually launched their Binance token, for those of you who don't know, back in 2017. This was their kind of first foray into the ICO space. But they were very, very clear that this was a token, right? Now we're on this whole idea of stock tokens, which gets people thinking, okay, I own fractionalized shares, but at the end of it, you don't actually own those shares. You don't at all. You own a mimic derivative contract of those shares, maybe, kind of, not sure, read the fine print. Sorry, we don't have fine print. And that, for me, is as the ecosystem expands and so much liquidity flushes into the market, people will naturally lower their guard and tend to get a bit sloppy around this. Regulators are not. Regulators will continue to push forward with this and make sure that people don't, basically fall foul of the law. But from an investor perspective, it's an easy money climate right now, but there's no such thing as easy money when things basically turn south, and you better protect yourself. So that's the message from me on this.
Yeah. Ben, I've always liked Warren Buffett has this line when he says, it's only when the tide goes out that you see who's been swimming naked. And I think that's something that people often forget. And, quite frankly, you mentioned Binance, their own BNB token. I think that's a very interesting example, because the way that Binance has always promoted BNB is not just as a pure ICO, it's as effectively, I would call it an STO in Hin's definition just now. Right? They say every quarter we promise to burn a portion of tokens equal to Binance's quarterly revenue. Now, I've asked people in the past, that's great. Number one, how do I know what their revenue is? To which someone answered, just check Twitter. They publish it there every quarter. But beyond that, I think that people are buying into this token because there is a security-like feature, but the reality is that it's all based on a promise. Binance could tomorrow say, actually, sorry, we've canceled this token. We're going to do BNB version 2.0. And then literally $100 billion worth of value will just vanish into thin air. And my personal belief is that there's no reason at all why you can't actually do all of these things for real. If you want to issue digital shares, why don't you just do it? If you want to call it a stock token, why don't you actually issue shares? There is no good reason why you can't actually take a real share and put them on the blockchain. And I think that regulators actually take offense when people point to them and blame them, saying that, because of regulators, we can't do this right now. Every regulator I talk to says, look, this is complete nonsense. If you follow our usual securities rules, we're quite happy for you to use new technology. And besides, we really want you to follow our securities rules. We'll be much happier if you issued real securities or even real derivatives the way that we're used to, as opposed to issuing these tokens that have no rights or no investor protections whatsoever. And so whether you are going to go the whole hog, as I call it, and issue real shares, real bonds, real digital securities on the blockchain, or if you, still want to issue what I call STOs, where there is some kind of derivative feature, maybe it's linked to revenue, etc., at least do it properly, right? There are legal ways that you can do these things for real. But even that middle category, when it comes to STOs, I think that people need to be very careful in terms of actually explaining to investors what they are really getting, right? Even if it is all legal and above board. For example, I see more and more crypto companies especially trying to create STOs where there's a feature where it says like, okay, we'll give you 20% of our top line revenue. And again, if you do it right, you pay some lawyers, there are entirely legitimate ways of doing this, but I still think it's worthwhile for investors to say, wait, do I really understand the implications of this? Because it sounds good on the tin, right? I get 20% of revenue. But for example, if one of these companies that issued a revenue token turned around tomorrow and sold themselves for billions of dollars to Google, you wouldn't get a dime because that's not revenue, right? Google would say, thank you very much for playing. We're canceling this contract now. And you guys don't get anything. Equity holders keep all of the money. And I've actually seen this happen before. Not to name names, but I remember there was a crypto exchange actually operating out of Hong Kong a while ago. They issued an ICO, raised about 50 million US dollars. So this is a real ICO, not an STO, just a pure, here's our exchange token model, raised $50 million. Honestly, business wasn't doing very well. They ended up selling out to a bigger crypto exchange for $50 million. Now, you raise 50 million and you sell for 50 million, that means, quite frankly, total failure as a business. But because that was an ICO, they just canceled the token. They owned 100% of the equity. So they walked away free and clear with $50 million. And again, these kind of situations, when you say, hold on, investors put in a whole bunch of money, didn't get a dime, business failed, and yet the founders got paid generously. That just doesn't seem quite right. And to me, these are exactly the kind of scenarios that are easy to avoid if you're issuing real shares. When you say, look, you just put investors side by side with founders, employees, everyone else. Maybe the business works, maybe it doesn't, right? That's the nature of startups, but at least we're all side by side, right? There are no differential rights.
Very true. Yeah, I mean, going to Hin's earlier kind of analysis, if I look at the kinds of STO style tokens that are out there, there's like the Binance coin, the Huobi token. Yeah. This gives you, basically it's discount on exchange fees and maybe discounts on, purchases in partner stores. Then you have this whole evolution of what I would call private security tokens. And the use cases are things like your T0s, BCAP, Spice VC token. This is where you start to get, as Henry mentioned, a proportion of revenue. So for example, T0's TZROP gives you a quarterly dividend worth 10% of adjusted gross revenue. If you go to Spice VC, dividends are distributed based on portfolio exits of the funds, and then each token you own directly represents a share of your limited partnership within that fund. If you go into something like BCAP, that's another one, basically you enjoy through your token holding a capital gain through that secondary market. But the reality is you might get entitled to some of, on paper, the actual top line economics of these businesses. But the question is there anything underpinning that? Is there anything more? And Henry's example of something that can be very fleeting, and then you can find out that, if a company sells out, what do you really get? The third kind of evolution is more the public security token, right? Something that's actually, publicly tradable. And this is where you've seen the only kind of potential use case out there is INX, right? And INX basically launched their INX token back in, I can't remember the exact date, 2020, 2021. It was basically fairly recently. That gives you a 40% mandatory profit share scheme, and then a 10% transaction discount on the INX platform. The reality is you go into this kind of space and you look at, okay, you get 40% of that. Token holders basically act as what you call unsecured credited and rank basically pari passu with all other unsecured creditors in INX. And given that the token holders receive 40% of the future adjusted operating cash flows, future profits of INX are effectively being sold, right? And then the token holders' rights are not senior in rights claims of interest to the company's shareholders. So there's basically a lot of uncertainties around that. And there's going to be a lot of basically confusion around even the auditing of this company due to the 40% handout given to token holders. A lot of confusion because it's trying to kind of find somewhere to fit in this kind of true native digital security versus I'll kind of provide as many features as possible, but it's not really meeting the standard of what is required.
Absolutely. I do think it's good to see at least people are trending in the right direction though, as the market evolves. You know, as I said, there's some things I look at, I won't name names, but I look at and I say, man, that just seems downright illegal. It's good to see people actually going through the right steps to make sure that they've checked the legal and regulatory boxes. But I think the extra step that the market needs to go through is to say, is this really in the investor's best interests, right? Am I kind of serving the best interests by coming up with some of these rather complex products? And that's why, look, I'm obviously, I think a lot of you here will know that, you know, Fusang has issued our own equity and we've tried to do so, or we're imminently about to do so in a public fashion, but we've already digitized 100% of our equity on the blockchain. But I bring this up just because, you know, however you want to structure these tokens, whatever type of security you're issuing, debt, equity, what have you, I don't see any reason why you can't have all of the sexy features from ICOs and utility tokens and still layer it on top of a real security. I think that ICOs are a great proof of concept. The idea of having a token power a value network makes a lot of sense. And you can see that people resonate with that idea because you can see the valuations on CoinMarketCap. But I think that if you take that same utility token with all of its utility features and you lay it on top of real equity, real shares, for example, now you've got something very interesting. A super token, as I like to call it. Yeah. Where you say, look, we can still move this around. You still have all the benefits of a digital blockchain-based asset, but at least there's a value anchor, right? People don't have to worry about what if you cancel this tomorrow, or what if you just, I don't know, get bored with playing with this project and decide to start over. You know, if something is company shares, at least you always have an interest in what you do, no matter what, or what the company does going forward.
Yeah,
I think it's totally possible to have clarity in the legal entitlements that we have as an owner of a digital native bond or share. And that really contrasts with the sheer amount of leeway that companies have in relation to structuring their tokens in a way that allows them to cancel rights at a moment's notice. For example, as Henry, you just said that with a revenue token, if it merges with another company and forms a new entity, or maybe it's acquired by another company, what happens? Well, the reason why these companies are able to cancel their tokens is because the original company wouldn't be producing any revenue because it's a new entity now. And then this means that the old company is defunct, and by definition, it produces no revenue. And so this is a classic legal loophole that can be avoided. And we can provide that assurance to investors by structuring the bond or the share in the correct legal form.
Absolutely. Hey, we're fast playing through time. We'd love to hear from the audience. If anybody has any questions, you can raise your hand. Ideally, physically, I can see all of you on camera right now, and the ones of you who have your videos on anyway. Raise your hand or type in the chat. You've got some.
While people think of their questions, I guess the one interesting thing is, okay, so what's the big name on the street that tried to do this in the proper way? Coinbase, right? So let's actually do a listing. For those of you who don't know, check Coinbase's share price on NASDAQ. It's a bit not exactly the most compelling thing, and there was a distinct lack of retail interest in Coinbase's listing. Because you imagine for a retail investor, I did a post on this, Henry and I have discussed this, at length as well. But you say to all your user community, okay, go and set up a traditional re-intermediated brokerage account, top it up with fiat currency, pay a brokerage fee to your broker to buy into our crypto exchange, which is now listed on a traditional exchange. So for me, that's like a daft customer journey and experience for people that are supposed to be very much behind this next wave evolution. And I do think as the world, we have moved as a world from what is a centralized economy to a platform economy very recently to what is actually a protocol economy, right? And in the protocol economy, I truly believe that there is no reason why having stakeholder capitalism at work and also attaching the rights that go with it cannot coexist. Because right now it seems to be heavily bifurcated between you either have a token that doesn't do anything for you, maybe some benefits, but this is very much a spec play, and if things go wrong, tough. Or you have the experience of Coinbase, which is we're trying to create a share, a traditional regulated share of a cryptocurrency exchange, which just delivers the worst possible user experience, imaginable for the crypto community. So, there is an opportunity to bring these two worlds together.
Couldn't agree more. We should do a whole nother webinar on this, Ben. I think there are a lot of interesting things to unpack in there.
Absolutely.
Mohan, I see you raising your hand. There you are.
Hi.
Spotlight.
Hi. In Malaysia, we have a investor alert to say that don't buy anything from Binance. But and we've got 3 regulated exchanges in Malaysia, and obviously the margins that Binance actually does its business is very, very much smaller than the regulated entities. The problem is that when you have regulated entities, you have, of course, all the protections and what have you. But the fact that it makes it so expensive, and there is this huge sort of push by the legacy, institutions to try to retain as much control as possible. So in Binance, is it not possible that people would just basically trust code is law and just go for the shares? Because there is, the Binance ecosystem is that, and everything is running on a protocol basis, right? So we eliminate this issue of human sort of what you call intervention and fraud. Yep. But it'll be interesting to see that it doesn't stop me from actually buying Binance, unless there is a law in Malaysia to say that if you buy Binance, then you go to jail. But it'll be interesting to see how this new tokens basically pick up. Obviously, if it goes bust, you lose your money. But it's very interesting because it cuts all the costs. It makes it very, very liquid. It's basically a new world. So I don't know, but people might just want to sort of dabble in it. And of course, if you lose it, there's just no way that you have any recourse. So interesting to watch, I think.
I think you can do all of that and still have it be regulated and still have it be backed by something real. I don't buy the argument that it has to be either or, as Ben was saying. That's the distinction that people are trying to draw now, to say, look, tokens are great. There are lots of benefits of tokens. I like them. That's why I've converted all of our equity into tokenized shares. But I don't buy that it has to be either or. I think that code could be law, but the question is, what's the stuff? What is the code? Right? Where is the stuff behind it that is backing it?
The fractionalized ownership discussion is also very interesting because you have to work out what benefit does fractional ownership give you over and above, or what are you giving up to get your fractional ownership? Unless you're buying Berkshire Hathaway stock, because of the sticker price attached to it. My question would be why there's so many stocks out there that you don't necessarily have to fractionalize, because the entry point with price is not what I would call prohibitive. But again, it's what you forego in that journey. I think as well, to your point, it's actually quite a good thing that you raised, but I don't think it's regulation that's causing the prohibitively high cost. I think the reality is Binance benefits from massive scale, right? Massive liquidity, massive user base. The compliance costs associated with it would not meaningfully move the needle on the operating model of this business were it to be compliant. It would change a little bit of the user experience, but it would guarantee them protections. Now, none of this matters when markets are doing well. No one cares. It's just when things go wrong. And we all know things go wrong. And as soon as they go wrong, then what happens? Regulators never are on the front foot ahead of the market. they always respond. And as soon as that happens, the regulator steps in, puts their foot down and said, enough of this, right? People are getting shafted and burnt because they own nothing. And it's just a casino with no legal rights, nothing associated with financial markets, but you're trying to basically deploy all the characteristics of what is a traditional financial system. So again, goes back to my point of reg arbitrage window will narrow and it will become more of the norm rather than the exception.
And most casinos, actually all casinos, have regulation too, Ben. Even actually, especially things like basic AML regulation actually applies very specifically to most casinos, most places.
Yeah.
And sort of to add to that, it's a very good point, Ben, because many cryptocurrency exchanges have been hacked before. So we've had the Cryptopia exchange, and that went bankrupt. And there was a case that was litigated all the way up to the New Zealand High Court, where they were basically trying to figure out the investor's entitlement. And then that made the judges work really hard to try and break new ground and say that cryptocurrency is a property to protect certain classes of investors. And so that it's really important to note that we're in a bull market right now, but when the music stops, someone has to pick up the tab.
Yes, exactly.
Hey, if I could call on someone out of the blue, Xin-Ming, are you there? I see you on the call. I hope you don't mind, because I see that we were quoted in the same forecast article with me talking about Binance stock tokens. Would love to hear if you have any thoughts about this whole saga.
Yes, Henry. Yes, so forecast, they contacted me about this, to ask me to give some comment, and frankly speaking, I didn't know that much, and then I just read up on their press release and, and try to figure out what they're trying to do. And my first reaction is that this is something that is so new to the market, and so my response to forecast was that better be careful. There's no regulation around this thing yet, and so there's a lot of uncertainty. So whoever who wants to invest in this sort of thing, you must be very clear about the uncertain risk that you are facing before you step foot into this sort of a very new fancy sort of tech product.
Mm-hmm. Why and sorry to call on you out of the blue, but why do you think people are so willing to trade it though? I mean, Binance, I think, does tens of millions of dollars a day now, cumulative across a couple of similar stock tokens, as they call them. To Mohan's point, no one really seems to care.
Well, I think as Ben said just now, the market is doing so well now, and almost everything is going up, especially cryptocurrencies this year has been doing so well, driven by the surge in Bitcoin and other cryptos. And so I think when there are a lot of speculators out there, there are a lot of people who don't understand the risk enough, and when they see a new fancy product coming into the market, everybody wants to come to jump into the bandwagon and get a piece of it, and hope that they are getting into the action in time before it crashes at some point. I don't know.
Yeah, FOMO, I guess, powerful human force.
Yes. Yeah. Ryan has a question. The drivers of companies tokenizing their stocks. Look, maybe I was a little bit cynical. Tokenization does have some benefits, and then I'm sure Henry and Hin could add to this. But if you cluster it, like there's a couple of things. The programmability, right? So the whole idea that because transactions can be programmed on specified conditions, you eliminate the need for a lot of intermediaries. Liquidity in particular, potentially wider investor base, but it's also the possibility of the peer-to-peer transaction angle. Transparency should be provided because it's all on, or it depends on the blockchain type. But overall, that one golden source of truth and the ability to access via your viewing key which should technically be a benefit from a cybersecurity perspective. But the whole disintermediation point, the ability for companies to tap into investors at lower cost, improve efficiency, faster speed, better transparency, costing, like if you go do a traditional IPO, very, very, very expensive. A lot of the exchanges trying to do STO style tokenized issuance of your stock will charge you a heck of a lot less. The clearing and settlement times, is no longer a T+2. This is basically instantaneous. And that bodes pretty well for the ecosystem. But again, I'm all for what I would call the objective narrative of why these things work, or why tokenization as a concept is something that I would support. But I would not support it in the view that you have to forego so much in the journey to achieve these things. My view is the world has not quite seen the convergence of tokenization with full regulation of what is a native security, because I would say the participants in the ecosystem are still learning. And this is what I would call the next frontier. You need the sponsors and the banks and everyone to start to get involved and take these deals to market. They all will. It's just not right now, but they will.
Yeah,
it's no question.
Couldn't agree more. Well, if you're open to it, Ben, we should have a follow-on chat and not do another webinar, talk about Coinbase, because I think that's a whole interesting another half of this, the discussion. We've been talking about a lot of the negatives with dealing with these unregulated tokens. I think that there are a lot of actual positives to issuing, blockchain-based digital assets, as I like to call them. And I think that Coinbase is a great example of why people like Coinbase should have done this for real and actually issue themselves as a token, but real shares. Maybe a discussion for another time.
There's just one final thing is, even if I ask every single person on this call, what would you prefer? Would you prefer to buy into a tokenized crypto, which gives you all the rights, benefits, and privileges of owning a security, or not? It's really that kind of a binary question. Or do you want to speculate on something that is not tied to it? I would struggle to understand if you could delve into the regulated aspect where you could get exposure to exactly the same thing, but be protected. I do not know why people would shun that avenue and go for the completely unregulated, unprotected route.
Exactly. And we've written a piece last week about why we think the Binance stock token is not real. And maybe future pieces can come in this sort of series where we talk about different types of coins, different types of security tokens, ICOs, STOs, and real shares to really draw out the contrast between the different types of products in this crypto world.
Fantastic. Couldn't agree more with either.
I've linked it in the chat.
Fantastic. Look, we're running way over time. I think we scheduled this for half an hour, and I'm surprised that everyone stayed so far beyond. So thank you, everybody, for coming and joining us today. If you're interested in, I guess, learning about how Fusang is trying to do these things for real and actually issue digital blockchain-based tokens, go look us up in the community. And if you didn't come to this call through the community, you can just go to your, I think Hin, actually behind his head, has a bunch of ways that you can move your head and you can look for us in one of the stores. So
I suppose my head's in the way, but
cool.
Yeah,
and come learn how we do it. Like I said, we don't buy that it's not possible to do. We've done it for our own shares, and we're hoping that lots of other people will start doing it besides. Fantastic. Well, thank you, everybody. And stay tuned. Like I said, if Ben's free, maybe we'll do a round 2 in 2 weeks' time, and we'll talk about Coinbase and many other things besides.
I'm keen on that.
Fantastic. Thanks, everybody.
Thanks, everyone.
Take care. Bye.